I didn't see this Omicron thing coming. So I was fully invested. I didn't sell into it. I'm envious. I'm envious of everybody here buying. But at the same time, I'm looking at the portfolio I run. It's down 4% over the last week. I'll live with it. Yeah, I wish I had some cash right now. I don't. But I am comfortable, Scott, that Omicron is a head fake. And the reason I say that is because if you look at the internals of the stock market, it never recovered from Delta. It just didn't. Going into the weekend, if you look at any of the reopening stocks, airlines down, the Jets ETF down 15% since May, hotels down 15%. There was a bloodbath before Omicron. In my opinion, that sort of was the market had already baked in Omicron, even though it didn't know it was coming. So I'm staying in. I'm certainly not selling, but of course I wish I had some cash right now.
All right, Jimmy, let me play this off you, okay? Maybe you're right. Let's hope you're right about Omicron. Don't know.
Okay.
Still too early, yeah. Okay? So let's just say you're right, and it's milder than maybe the first fears, et cetera, but then I still got to deal with the Fed. And that's a good debate to have because the debate is being had right now on the street. I've got J.P. Morgan's Marko Kolanovic. We highlight his notes all the time. He says, what if this new variant ends up positive for risk? For a variety of reasons he talks about. But then I've got Savita Subramanian over at Bank of America. She says, we're cautious on the S&P. Why? Because hawkish Fed tightening into an overvalued market. So all things equal, you're right on the virus. How do I deal with the Fed, though?
And listen, it's a good question, and I appreciate that you said we don't know, because I don't know.
Well, you sound so definitive, though, as you say, it's next to nothing. I mean, right? You may be a farmer, but you're not an epidemiologist, so let's just throw that out there.
Yeah, no, it's absolutely right. But I will say I always want to be clear in my opinions, and I certainly think I'm being that way. When it comes to the Fed, which 2 days ago I was on the show, and you heard me say I think it's the most important force out there. It's a fact that right now they are buying $105 billion of bonds a month. That's just a fact. We know they're going to talk about tapering in an accelerated fashion, but that hasn't happened yet. Right now, that cash that's coming in via the Fed is going to be supportive of this dip. Now, I also want to say this because I don't want to be blasé and I don't want to pretend to know things that are unknowable. But if you look at the last two Fed rate hike cycles, from the time that the first rate hike was issued, which right now we're thinking, what is it, May, June of next year? You had 2 years in each of those cycles of 10% plus returns on the S&P 500. When the Fed gets aggressive, it doesn't immediately tank the market. What it does is increase volatility, but the markets still go up, and I expect that's what's going to happen now because economically, things look pretty good. Atlanta Fed now, GDP is 9.6% for this quarter.
Yeah.